video training module on financial statements from businesstraining.com. Welcome everyone. The goal of this presentation is to explain what are the most important financial statements, the main connections between them, and how to analyze them in Excel using financial ratios. What kind of financial statements do you know? Balance sheet, profit and loss account, cash flow. Great. Do you know what the difference between them is? A balance sheet. Assets equals to liabilities and capital, or shareholders' equity. From the file below, you can download a balance sheet template in Excel. Balance sheet is a snapshot of the firm's position at a point in time, usually end of month or fiscal year end. It shows what a company owns, assets, and what it owes, liabilities. Balance sheet shows what assets a company has, the use of funds, and where the money came from to acquire those assets, the source of funds. Profit and loss account, or income statement, both names are used. It refers to a certain period, year-to-date picture. Main parts are revenues or income and expenses. Again, from the file below you can download an income statement template in Excel. Profit and loss statement shows the flow of sales and costs over a period. It shows the level of profit or loss made, and it also shows what has been done with the profit or loss. Cash flow means that you project your cash inflows and your cash outflows. Then you put the projections together to come up with your cash flow bottom line. Cash flow is crucial to a company's survival. It is often used by analysts to assess a company's financial performance. From the file below, you can download a cash flow budget template in Excel. Now we have reviewed the financial statements, balance sheet, income statement, and cash flow. So let's see what the connection between them is. What is the connection between sales revenue account and accounts receivable? The size of the two accounts is connected. Accounts receivable account shows the part of sales revenue that has not been paid yet. The sales revenue account is on the left side of the screen. This accumulates all sales made during the year. Its opening balance is 0. It can be earned through credit, cash, or credit card. When on credit, accounts receivable is entered. It includes prompt payment discount. Accounts receivable account. The average sales credit period determines the size of the accounts receivable account. Now let's move on to the respective ratios: accounts receivable turnover ratio and average sales credit period. Accounts receivables turnover ratio equals the sales revenue divided by accounts receivable. Based on the financial statements shown on the previous slide, it is 10.4 times. Average sales credit period equals to number of weeks divided by accounts receivable turnover ratio. Based on the financial statements shown on the previous slide, we know it is 5 weeks. These ratios show how long it takes on average to turn accounts receivable into cash. It is important to know how long it takes on average to turn ARs into cash. Based on this, the manager can decide the following: to shorten credit terms, to shut off credit to slow payers, to set up collection efforts. There is a connection between inventory on the balance sheet and cost of goods sold on the income statement. Cost of goods sold. Cost of goods sold is generally the largest expense of a company. It is an income statement item. Sales revenue minus cost of goods sold equals gross margin. The inventory is a stock of product on hand necessary to satisfy demand. Reported at cost in the balance sheet, not at its sales value. It is an accumulated cost of products purchased and manufactured. Acquisition cost stays in inventory until the products are sold. Then it is booked to cost of goods. A product may have a short or a long holding period that frees a substantial amount of capital. Now let's move on to the respective ratios. Inventory turnover ratio and inventory holding period. Inventory turnover ratio equals the cost of goods sold expense divided by inventory. Based on the financial statements shown on the previous slide, it is 4 times. Inventory holding period equals the number of weeks divided by inventory turnover ratio. Based on the financial statements shown on the previous slide, we know it is 13 weeks. It shows how long a company has to hold inventory before products are sold. It is essential to look at how long a company has to hold inventory before products are sold. This way, it includes the production process time and warehouse storage time. Internally, managers separate work in process inventory and finished goods inventory. Businesses invest substantial capital into inventory. Reducing inventory increases cash balance, but also risks stockouts. When inventory holding period is high, capital is being wasted, and when it is low, we might miss profit opportunities for the business. The right balance is essential, therefore. Companies need to benchmark to competitors and historical trends by using industry data to determine the right level of inventory. Depreciation and amortization expense is connected to the fixed assets part of the balance sheet. See in red on the right side of the slide. We say depreciation in case of tangible assets, machines, equipment, buildings, etc. Depreciation methods can be accelerated or straight line. These are the most common ones. We say amortization in case of intangible assets such as goodwill, licenses, etc. Depreciation and amortization is not deducted directly from asset on the balance sheet, but on accumulated account. Yearly depreciation and amortization expense affects profit on income statements. These are costs that are not directly matching sales revenue, but they still need to be recorded to the period in which the benefit to the business occurs. These costs of long-lived operating assets are spread out over their useful lives. It is not only reflecting the loss of value, but it is a cost allocation method. In brief, the costs of these assets are allocated over their estimated economic lives, and the annual amount of depreciation or amortization expense is not deducted directly from the asset account, but it is accumulated in a contra or offset account called accumulated depreciation or amortization, and that is deducted from the asset account. In the balance sheet, the original cost is recorded. Original cost depreciation equals the book value. Accruing unpaid expenses. At the end of a period, it happens that a company needs to look for expenses that have occurred and neither has been paid, nor there is any invoice or bill received for them. An example: commission based on sales for the last month of a period, telephone, electricity costs, interest on debts. Failure to record results in liabilities and expenses being understated. Accounts payable and accrued expenses are generally non-interest bearing liabilities. Interest expenses depend on how the company is financed. The choice is between debt or equity. Interest rates are stated as annual rates. Connection between income tax expense and income tax payable. We need to first earn taxable income to pay income tax. The simplest way to pay no income tax is to have no taxable income or to have taxable loss. There are loopholes and options in income tax code to minimize taxable income and to shift taxable income from one year to other years. There are usually installment payments during the year. GAAP. When postponing income tax to later years, the income tax expense needs to be consistent with earning before income tax. So the difference between paid and calculated income tax is recorded under deferred income tax account in balance sheet liabilities. Connection between net income and retained earnings. Two separate equity accounts is needed legally. Capital invested by owners, the non-taxable when distributed to owners, and retained earnings, taxable when distributed to owners. Annual profit is entered as an increase. Distribution of profit as a decrease to the account. If losses over the years are higher than profits, retained earnings account becomes negative. To avoid misunderstanding, it is not cash. There are 8 changes in operating assets and liabilities that determine cash flow. Accounts receivable, inventory, prepaid expenses, depreciation, amortization, accounts payable, accrued expenses, and income tax payable. Business managers have a double duty. First to earn profits, then to convert the profit into cash as soon as possible. Waiting too long to turn profit into cash reduces its value. Business managers should be clear on the difference between profit reported in the income statement and the amount of cash flow from profit during the year. To get from net income to its cash flow result, we have to make adjustments along the way. Each is caused by a change during the year in one of the company's assets and liabilities. Accounts receivable increased by 320. Accounts receivable increased by 320. It means cash outflow. Inventory. There is a large increase compared to last year's inventory. Balance 935. Cash outflow. Prepaid expenses. The balance increased with a cash flow of negative 275. Depreciation and amortization. The company pays for them when it buys them. This year, no cash outlay. Balance is positive 785 and positive 325, which equals positive 1,110. Account payable. Paid last year, accounts payable 2,675. Not paid 3,320. Balance is positive 645. Accrued expenses. Virtually the same as accounts payable, not paid. 1,515. Paid. 1,035. It's a balance of positive 480. Income tax. The net effect of positive 83. To sum up, there is a positive cash flow balance from operating activities. We have reviewed what are the most important financial statements and their main parts. We discussed what a balance sheet is. It shows a company's assets, liabilities, and capital in a point of time. We discussed that We've reviewed what are the most important financial statements and their main parts. We discussed what a balance sheet is. It shows a company's assets, liabilities, and capital in a point of time. We discussed that an income statement is summarizing the revenues and expenses year to date. Finally, we looked at the cash flow, showing the cash inflows and cash outflows of the year. We have reviewed what are the most important financial statements and their main parts. We discussed what a balance sheet is. It shows a company's assets, liabilities, and capital at a point of time. We discussed that an income statement is summarizing the revenues and expenses year to date. Finally, we looked at the cash flow, showing the cash inflows and cash outflows of the company. We also reviewed the main connections between these statements, such as sales revenues and accounts receivable or inventory and cost of goods. Thank you for your attention. If you have any questions, please contact us.